This is Nightly Business Report with Sue Herrera and Bill Griffin.
Down 28,000. The three major indexes close the week at records as a rush of euphoria hits Wall Street.
Bold bets. With the market at all-time highs, our market monitor has a list of stocks that he says could climb 30% over the next year.
New prognosis. The White House wants to force hospitals to reveal the price of care so that people can look for better deals, and the sector rallies. Those stories and much more tonight on Nightly Business Report for Friday, November 15th.
Good evening, everyone, and welcome. The bulls are out on Wall Street. The major averages all closed at records. The Dow above 28,000, thanks to optimism on a trade deal, a rally in healthcare stocks, and an upbeat report on retail sales, which is an indication that the consumer, which has been powering this economy, is still strong. Here are the closing numbers. The Dow Jones Industrial Average rose 222 points to 28,004. The Nasdaq was up 61 and the S&P 500 added 23. It was the sixth straight weekly gain for the S&P 500, the longest win streak for that index since 2017. Bob Pisani takes a look at what to make of all this bullishness.
We had another day of record highs. Now the S&P has broken out of its trading range into record territory. Euphoria has been growing and pretty fast, frankly. A number of technicians have been positively giddy recently, but it's not just the chartists who feel good about the trends they're seeing. Even strategists and everyday retail investors are starting to get really gung-ho on the markets. Barclays, for example, says that small caps are at a turning point and they're poised to outperform. Morgan Stanley also thinks a key rotation from growth stocks into value stocks is beginning. Even the average retail investor is getting all bulled up, according to the latest investor sentiment survey. That's from the American Association of Individual Investors. High levels of bullishness. So why is everybody so excited? Well, you could chalk it up to a combination of a neutral and supportive Federal Reserve, better global growth outlooks for 2020. But remember, there's also seasonal strength, and there's higher hopes for an eventual U.S.-China trade deal that's also factoring very heavily into the equation. Everybody seems to think that FOMO, fear of missing out, is going to cause institutional players to buy into the end of the year. The only thing that can really throw a wrench in the works is a breakdown in the China negotiations. Still, some market observers are not impressed. So Brian Belsky at BMO Capital noted that many on Wall Street are habitually late to the party. He said people get bullish after the market rallies. That's a good point. He thinks there is some froth in the market as everyone on Wall Street chases performance going into the end of the year. And he does have a point. All this euphoria would be great if we were coming off of a big sell-off, but we're not. Stocks are at new highs. Breadth is strong. Put it all together, the market looks a little frothy right now. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
And as Sue mentioned, stocks got a late-day lift from healthcare stocks after the Trump administration released a plan that would force hospitals and insurance companies to disclose the price of their care. That sent shares of insurers higher, like Anthem, Humana, United Health, and Cigna. Hospital operators like Community Health, Tenet, and HCA Holdings also rallied. Bertha Coombs has more details.
The Trump administration's new transparency rules would require hospitals to publish insurance-negotiated prices for some 300 procedures starting in 2021. The president arguing the move will give patients more control and the transparency will help push system prices lower.
This will allow you to see your out-of-pocket costs and other vital price information before you go in for treatment. So you're going to know what it's going to be, and you're going to be able to have lots of choices.
4 major hospital associations vowed to take legal action to stop the new rules, arguing that publishing their negotiated rates with insurers will be too confusing for consumers. But policy experts say the rules aren't as onerous as feared.
The penalty for not revealing the information, $300 a day. In the whole hospital industry, it's a few $100 million. That's in an industry that makes $1.3 trillion. You know, ignoring this executive order is not going to be very painful for most hospitals.
Meantime, insurers argue that publishing their negotiated rates would make it harder to drive a bargain with hospitals to lower costs for consumers.
The worry here is hospitals won't reduce their price. One hospital in the city will look across town and say, oh, he's getting more.
For investors, the news and the potential impact of the rules clearly not seen as bad as some had feared earlier this year. The S&P 500 healthcare sector, in fact, hitting a new record high today, with strength both in hospital and insurer stocks. And health insurers are now up 20% over 7 straight weeks of gains. For Nightly Business Report, I'm Bertha Coombs.
Retail sales rebounded in October. Sales increased 0.3% last month, lifted by car purchases and higher gas prices, reversing September's decline. But consumers did pull back on big-ticket household items and clothing. Experts say that could temper some excitement for a strong holiday shopping season. So joining us now to talk more about retail sales and the consumer is Michael Lasser, retail analyst for UBS. Michael, welcome. Nice to have you here.
Good evening, Bill and Sue. Thanks for having me.
Are you at all worried? I mean, the report was better than a lot of people thought it would be. Are you worried at all about that pullback by consumers on the bigger ticket items and clothing?
No, I'm not. I think the consumer is on good footing as we merge into the holiday season. Household balance sheets are in good shape. Wages are rising and unemployment is low. Those are 3 important foundational elements of what should drive healthy consumer spending over the holiday season.
Winners and losers as we go into the holiday season here. And I'm curious your thoughts on the department stores themselves and which category they fit in right now.
Well, what I would tell you is that apparel is a difficult category. We heard when Walmart reported yesterday, they noted that apparel was an area of weakness. That was in part because of the uncooperative weather. It's been a bit warm just up until recently.
Right.
And as a result, people haven't been buying apparel. The winners will clearly be those that have effective omni-channel offerings. One of the notable points from this retail sales report was that the e-commerce channel continues to do quite well. So those that can blend a good in-store experience along with a robust omni-channel experience are going to be well positioned for this holiday season. Should
consumers expect a lot of discounting or promotional things? I mean, they're pretty used to that.
Absolutely. And Sue, it's a good question because a lot of these retailers have brought in pretty heavy inventory levels ahead of all the tariff uncertainty. So that, coupled with the fact that the holiday always tends to be promotional, you should expect to see heavy discounting throughout the next few weeks.
I'm curious about home goods as well. They seem to be doing very well, and I think specifically of RH, which used to be called Restoration Hardware, which now has a big fan in Berkshire Hathaway. What about that sector? It's doing so well all of a sudden.
It's a good question, Bill. Home furnishings is a sector that consumers are interested in because the housing market is very stable. It's an area that consumers choose to continue to invest in. It is being impacted by the tariffs. We heard that from some of the players like Wayfair thus far. But nonetheless, we expect that home furnishings will be stable as we move through the holiday season.
Michael Lasser from UBS. Michael, thank you.
Thank you very much.
And in the news tonight, day 2 of the impeachment hearing on Capitol Hill. Traders on Wall Street have been watching the testimony of former Ukraine Ambassador Maria Yovanovitch, who said that she was removed from her post after what she called a concerted campaign against her. Reaction to her testimony pretty much followed party lines. It ranged from compelling to irrelevant.
The Democrats running for the party's presidential nomination are trying to set themselves apart. We hear a lot about the progressive candidates and their economic platforms and things like a wealth tax and Medicare for all. But what about the moderates? Where do they stand? We asked Kayla Tausche to take a look.
While the progressive darlings of the Democratic Party have stolen the headlines,
it is time for a wealth tax.
A Medicare for all.
A handful of candidates led by Vice President Joe Biden, South Bend Mayor Pete Buttigieg, and Minnesota Senator Amy Klobuchar are not so quietly vying for the party's moderate vote, with lower-priced platforms to appeal to the wallets of the middle class, arguing that health care doesn't need to be run by the government.
We can do that without Medicare for all. We can do that by adding a public option.
Expanding some government programs, but leaving private options available too.
The way I would do it is to make sure that the choice rests with you. We're not going to kick you off your private plan if you don't want to be kicked off your private plan, because I trust you to figure out what the right plan is for you.
They all think higher education should be free for some, and that more student debt should be forgiven than is currently, but not all of it. And to pay for it, they'd roll back President Trump's corporate tax cut and raise taxes on certain income brackets and investments. Klobuchar says progressive candidates are obscuring the impact of that on ordinary people.
We have a big problem with our debt, and it may not affect you guys, but it's going to affect your kids and your grandkids. And so I want to be able to show how I'm going to pay for things as we move forward.
Buttigieg supports taxing unrealized capital gains on the top 1% of Americans.
We certainly need to consider a higher marginal tax rate for top income earners.
Biden says closing some loopholes could add up.
Eliminate one tax loophole. It's called stepped up basis. It only costs $17 billion to the government. That's what we don't. Eliminate that. I can put every single solitary person qualified for community college in community college for free.
Those messages are resonating with some Democrats in early voting states. Polls this week in New Hampshire and Iowa show Biden and Buttigieg in the lead in those respective states. But the leads are narrow, with Warren and Sanders not far behind and 2 months to go before the primaries. For Nightly Business Report, I'm Kayla Tausche in Washington.
Time to take a look at some of today's upgrades and downgrades. We begin with shares of Grubhub. They were upgraded to overweight from underweight at Barclays. The analyst cited the company's position as a dominant brand and its potential for growth as a result. Price target $51. That stock was up 3% today to $39.79. Qualcomm was upgraded to buy from neutral at Mizuho. The analyst cited the ramp up of 5G over the next 2 years in 2020 and 2021. Price target an even $100. Shares rose a fraction to $90.81. And NVIDIA was upgraded to buy from hold at Craig-Hallum. The analyst cited the company's strong third quarter results. Price target $255. That stock, though, fell more than 2.5% to $204.19 following those earnings that were reported last night.
Still ahead, remember WorldCom's Bernie Ebbers? Why he's seeking an early release from prison. Amazon plans to protest the Pentagon's award of a $10 billion cloud computing deal to Microsoft. Last night, the company expressed concern that the decision was based on politics and not a fair contracting process. As we reported last month, Microsoft beat out Amazon for the Joint Enterprise Defense Infrastructure Cloud project, otherwise known as JEDI.
Streaming service Hulu is hiking prices for the second time in less than a year, this time from $44.99 to $54.99 per month. Company says that the new price better reflects the substantial value of its Hulu Plus Live TV service. Just last month, AT&T raised the price of its TV Now service to $65. Experts say it's the latest sign that providers are having trouble making money on discounted packages that rival cable.
And as cord cutting picks up steam, media companies have a plan to battle back. Here's Julia Borston.
Media companies are pulling out all the stops to fight the growing cord-cutting threat. Pay TV subscriber declines accelerated to 1.8 million last quarter. That's the third consecutive quarter of over 1 million subscribers lost. AT&T, which owns DirecTV, is suffering the most, losing 1.1 million video subscribers last quarter. That's nearly 3 times its year-earlier loss.
The biggest factor when it comes to acceleration over the past quarter is that there's a confluence of new options available to consumers. Most of them are driven by newly emerged subscription services, most of which are actually effectively free to the consumer. So as a result, when you look at a person's time, more and more of that time can be spent on a subscription service and on options that are available over the top.
But while consumers drop TV bundles, they do need faster broadband or mobile internet to access streaming services. And that's where these media giants are focusing. AT&T growing its wireless customer base much faster than expected last quarter, while Comcast's high-speed internet customers grew at a record pace, its best third quarter in a decade. In fact, now Comcast calls broadband, not video, the foundation of our customer relationships. In addition to selling the pipes, media companies have 3 ways to tap into the shift to streaming. First, of course, there are the wave of subscription services such as Disney Plus and HBO Max. Second, there's selling content to streamers, as Viacom's Nickelodeon is to Netflix. And third, there's digital advertising on streaming apps.
I absolutely believe that the suppliers will continue investing in the free ad-supported services simply because the subscription marketplace is quite crowded at this time. But will the consumers actually gravitate to consistent usage of those services? That remains a big question mark.
Connected TV ads, such as those on Hulu or Roku, are expected to grow nearly 40% this year to $7 billion and to double in 4 years, according to eMarketer. While Hulu is Disney's bet on the digital ad market, NBC Universal will launch its ad-supported play, Peacock, next year. For Nightly Business Report, I'm Julia Borston in San Francisco.
Julia mentioned Comcast in her story, and as you know, Comcast is the parent company of CNBC, which produces this program.
T-Mobile's CEO is reportedly going to stay put. That's where we begin tonight's market focus. As first reported by CNBC, T-Mobile's chief executive John Legere is not taking the top job at WeWork, as was speculated on earlier in the week. T-Mobile is still waiting for its acquisition of Sprint to be approved by state attorneys general around the country. T-Mobile shares rose more than 1.5% today to $78.07. Strong online sales helped Alibaba's chief rival in China, JD.com, top Wall Street's expectations. The Chinese-based internet company has maintained solid growth in the industry despite the ongoing trade war with the United States. Shares fell a fraction today to $33.55. And JCPenney reported a smaller than expected loss as it sold more diamond jewelry and denim clothing in the latest quarter. The retailer did miss on revenue estimates, but it raised its financial outlook for the whole fiscal year. Shares gained more than 6% today to $1.17.
United Airlines is the latest carrier to extend its grounding of the Boeing 737 MAX. United's scheduled return date is now pushed to early March, which is a similar time frame to both American and Southwest. United shares fell a fraction to $92.51. And the world's largest Starbucks opened its doors in the Windy City. The Chicago store is 5 stories high, and it covers about 35,000 square feet, edging out its Tokyo location for the top spot. Starbucks shares were down a fraction to $84.21.
Time for our weekly market monitor, who has 3 names that he believes will grow as much as 30% over the next year. This is his first time on the program. We welcome Dave Harden. He's the president and chief investment officer at Summit Global Advisors. Dave, thanks for joining us tonight and welcome.
Thank you, Bill. Glad to be here.
A couple of those names are household names, and they've done very well this year, starting with Microsoft. You're expecting a 30% gain. It's already up that much this year alone. What's going to propel it even higher?
It's done very well. You know, this is a company that really fits into our baskets, really just our portfolios love this. We love outstanding companies with little to no downside risk, downside surprises. We really like to own outstanding companies with the least amount of surprises. And Microsoft here has a great management team. They're really executing. They were late to the cloud, but with the Jedi, being awarded, they're really executing very, very well. And it's all going to the bottom line. You have about $136 billion in cash. They're returning it to shareholders in a good dividend, almost as much as the 10-year. And so great company to own with a lot of upside potential.
Next on the list is Zoetis. And as a dog owner, you know, we spend a lot of money on our pets. And you say that, that they're very much well-positioned with their animal health line.
You know, they've become the market leader in this space for animals. And we do love our pets. And pets are a lot less political than the bio and everything else out there. So with your animals, Sue, I know you have a few, and mine, this is something we're willing to spend on with a lot less risk out there from a standpoint of other healthcare companies. So I like this. They have a lot of room to grow, good management team. And they've done well. All these have done well. But again, another outstanding company.
And then you have Walmart, of course, the #1 retailer, had good-looking earnings yesterday. But again, this is another stock that has had a stellar year, and you're expecting another one next year, I guess.
Well, Walmart's one that, let's say the economy doesn't do as well, they actually increase their volume. So they pick up in a down market, and in an up market where the consumer right now is doing so well, they grew over 40% on their online sales. Their groceries are doing well. So as people go to buy more groceries, they're picking up more shoes. It's a great story. We all know it very, very well. And they continue to execute. And this is a big market. They have a lot of room to grow, a lot of online to cover.
All right, very good. Dave Harden from Summit Global Investors. Again, thanks for joining us tonight, Dave.
You're welcome. Thanks for having me again.
Well, he presided over one of the biggest corporate frauds of all time. But now, just halfway through his prison sentence, former WorldCom CEO Bernard Ebbers wants to go free. Even the judge who sentenced him says that he has been punished enough. But has he? Scott Cohn has the story.
In his prime, he was known as the telecom cowboy, big, bold, brash, and loud.
The new company, which will be called WorldCom, is uniquely equipped to develop and market communications products and services that are growing the fastest: data, internet, wireless, local, and international.
Bernie Ebbers turned a small Mississippi long-distance company into a telecommunications behemoth. WorldCom's explosive growth in the 90s and competitors' frantic efforts to keep up helped give rise to the internet as we know it. But it turned out it was all built on a lie. $11 billion in accounting fraud, allegedly orchestrated by Ebbers himself to keep the illusion of growth going.
We are going to come up with the ball, and we are going to write this effort like we never have before.
He claimed he wasn't a numbers guy, that the fraud was the work of others.
What happened is not anything really different than a whole lot of other people, other than if it ends up being true that there's a lot of accounting issues. I don't know the facts on that. I haven't been privy to any of that information.
But a jury didn't buy it, convicting Ebbers on 9 counts in 2005, Judge Barbara Jones imposing what she acknowledged was a life sentence, 25 years. But now, 13 years after reporting to prison, Ebbers, now 78, wants out. According to court filings, he is blind, has heart disease, has withered to 160 pounds. His daughter says she fears he only has weeks to live. Even Judge Jones, now retired, says he's been punished enough. But prosecutors in New York say that life sentence should stand. Prison doctors have said as recently as this summer that his condition is not so dire. A new judge has asked to hear from WorldCom victims and asked for more medical data. If she doesn't set him free, Ebbers is not due for release until 2028, if he lives that long. For Nightly Business Report, I'm Scott Cohn.
Coming up, the rental market is red hot in Manhattan, even those with sky-high price tags. Next week, the housing market will be in focus, and here's a look at what to watch. On Monday, we'll hear from the home building industry about how optimistic they are on future orders. On Tuesday, a report on housing starts will indicate if groundbreaking on new construction is picking up. On Thursday, existing home sales for October are due, and that is what to watch for next week.
But finally tonight, when we talk about real estate, Manhattan is literally an island unto itself, operating with a different set of rules and prices, even in the luxury rental market. Robert Frank is in New York City for us tonight.
Luxury real estate sales have been falling in Manhattan for 2 years, but the wealthy who are not buying are renting. And that's created huge demand and huge prices for luxury real estate rentals. Prices for high-end rentals are up 4% this year, and at the very top, it's almost 4 times that, while luxury sales prices are down 10% this year. So why would people who can afford to buy choose to rent? New taxes have made owning and buying more expensive. The mansion tax on sales, the new cap on state and local taxes, and renewed talk about a pied-à-terre tax in New York City. With so much uncertainty in the New York real estate market, wealthy buyers are opting to camp out in rentals until prices fall further. And with the oversupply of luxury apartments, sellers are opting to rent to at least collect some money on units that are languishing on the market. The demand has led to a new segment in Manhattan real estate, the $100,000 a month rental. An apartment at 15 Central Park West rented for $125,000 a month this spring. And this apartment on Leonard Street downtown can be yours for $123,000 a month. It's got 6,000 square feet, 6 bedrooms, 4.5 baths, 14-foot ceilings, and at 56 stories high, views of all of Manhattan and both rivers.
Sometimes people want to try out the neighborhood. They want to try out to see if it's a building that they necessarily like. Other times there's people that only want to be in Manhattan for 6 months or 1 year at a time.
Now, the owners of this apartment, who bought it back in 2016 for $30 million, have received some offers for short-term rentals, but they want a year-long lease, which would total $1.4 million to rent. Sky-high views at sky-high prices. For Nightly Business Report, I'm Robert Frank in downtown Manhattan.
Wow. Before we go, here's another look at the day's final numbers on Wall Street. The Dow rose 222 points to close above 28,000 for the very first time. Speaking of sky high, the Nasdaq was up 61 and the S&P 500 added 23. It was the 6th straight weekly gain for the S&P 500, the longest win streak for that index since 2017. And on that note, that does it for us tonight. I'm Sue Herrera. Thanks for joining us.
Happy birthday, my dear.
Oh, thank you.
You young whippersnapper, you.
I wish.
I'm Bill Griffith. Have a great weekend, everybody. See you on Monday.
Thank you.